let's begin now
Thank
with
you.
what else? The overall markets. The Nasdaq is trying for its 12th straight day of gains. Now, if that happens, it would be the first time that has happened in a decade. So it's great, Jim. People are buying stocks. Feels like almost like they're worried about, just goosing it up, Santa Claus rally, whatever you want to call it. But I'm worried about what happens next week.
Listen, that's legitimate to be worried about it, but let's not worry too much. Let's be joyous, all right? Let's expect to ring in the new year with enthusiasm. And
we clearly are doing that.
Yeah, what I'm trying to say here is your caution is warranted. We probably will give some of this back in the new year, but that doesn't mean we have to have some sort of correction. I'm certainly not calling for that. All the forces are aligned right now for the market to at least be stable, if not go higher. And what do I mean by that? Fed's on the sideline. Trade tensions with China have eased, at least for the moment. You've got good labor reports. Profits should be growing next year. So I don't see any reason for a meaningful decline, but I would expect when you get to January that this rally at least stabilizes to a flat line.
Well, you say that the Fed is on the sidelines. I'm going to push back a little bit on that, Kari, because we know the Fed is not on the sidelines. They may not want us to call it quantitative easing. Don't call it QE. Yeah. But we'll call it QE because it's a form of that. The Fed's balance sheet is expanding dramatically. They're pushing $300 billion into the repo market on the last day of this year and the first trading day of next year. Yeah. The Fed is goosing this in some ways, are they not?
Yeah, I think that's fair. We know that in September there was a problem in the repo market, and that forced up interest rates to dramatically high levels. So the Fed is making sure that doesn't happen. But that's a good move. It's not something that we should be concerned about. On the other hand, there are people who say, well, this is part of the reason that we've had this bull market recently. But, if you think about the last 10 years and the rally we've had, there are many people who say, oh, it's all because of the Fed and easy money. And that's not necessarily the case. And even if it were the case, the truth is the market has had this enormous bull market. So those are real dollars. Those are real dollars.
And I don't want to imply, John, that it's all because of the Fed. But we have been taught for years and decades, don't fight the Fed. And a lot of people that you talk to, that I talk to, that we all talk to, that are big money hedge funds or big desks, what they're saying is when the Fed stepped back in, we doubled down.
Yep.
And they're following the Fed.
And they've been right to do so.
Sure.
And the people that faded that have not done
They've
very
gotten
well.
blown out, probably. In fact, that's probably short coverings probably contribute to part of this.
There are probably many of the managers who have gone to the sidelines and been retired in the last 2 years. And some very big names have done that. Because they could no longer take it. They stepped to the side. The market went zooming past them. They kept waiting for the pullbacks. When we got the one a year ago, basically last week, which was the low, the December 24th Christmas Eve low, that was the time when people could have stepped back in. And obviously, the very next trading day, we were up 1,000 points. So some people did step back in on that, Brian, but an awful lot of people, timing that is very difficult. And just as taking the profit
There's two ways to look at this. We go into a new year, Jim, and I get it. People say, well, nothing's changed but the date. In other words, the macro backdrop. But that's not entirely true because there's two things that matter in a calendar year. Tax implications, right? Buying and selling for tax reasons, and showing it, like we talked about yesterday, at the end of a year or an end of a quarter, that you owned certain things.
Yes.
Those things are things to consider heading into, the calendar flip.
I definitely agree and have been saying for quite some time that the absence of tax gain selling, however you want to phrase it, has helped this market go up. And, John, I think yesterday you called it a seller's strike, that at least in part is by people not wanting to sell in this tax year. The thing, though, is that does not automatically mean that on January 2nd everyone's pulling the trigger. What it does mean is that if January 2nd, 5th, whenever, there starts to be a rollover in the market, it could pick up speed with people saying, okay, it's gone too far. And there certainly are some names that are prime candidates for that. But what I'm trying to say here is, look, you don't expect to see a correction in the market. There's not enough forces to pull it down to a correction. What I really hope doesn't happen in terms of the calendar year, where I thought you were going to go with this, is people getting bonuses, putting it into the stock market, 401k contributions, the safe harbor contributions from companies. What I really don't want is a melt up in January. We saw that in January 2018.
You don't want that?
I don't want a melt up. A melt up is unsustainable. What I'd like to see is January is just a stable month. You get into the earnings reports, you get into February, and people start to say, hey, you know what? The rest of the year looks pretty good on the profit picture. Let's start rallying again, but sensibly, cautiously.